$660 billion. I mean, just think about that number for a second. That is the staggering amount of wealth Elon Musk has shed just since June. To put that into perspective, that is the equivalent of the combined net worth of Larry Page, Sergey Brin, and Jeff Bezos, just completely wiped out. That massive drop is the direct result of the fierce tech sell-off we're witnessing right now, and it really sets the dramatic stakes for everything we're going to unpack today. Welcome to The Explainer. I am so thrilled you're here, because today our goal is to untangle the absolute chaos of the 2026 market. We're navigating this crazy period of macro convergence and AI exhaustion. Think of it like a moment where these massive global economic storms are colliding head-on with severe AI burnout. What we're going to do is cut through the noise and reveal exactly where the smart money is moving to protect and grow capital. All right, let's dive right in. Here is our roadmap for today. We'll be covering the great market split, the drivers of volatility, the China shock 2.0, AI expectations versus reality, the massive capital cycle shift, and finally, we'll wrap up with the smart money playbook. Starting off with Section 1, the great market split. So right now, we are seeing the Dow and the Nasdaq completely decouple. It's a wildly divided market. Healthcare and consumer staples, they are driving a really broad S&P rally. In fact, 71% of stocks are actually gaining. But the tech sector is in timeout right now, exposing some incredibly deep duration risk. Essentially, investors are just no longer willing to wait years and years for a return on their investment. Because of this, we're seeing things we never thought we'd see so soon. Apple is now a $5 trillion behemoth, dethroning Nvidia as the world's most valuable company. Meanwhile, high-growth names like Tesla and SpaceX are taking massive haircuts. It is a fundamental recalibration of risk. Which brings us to Section 2, drivers of volatility. So why exactly is this happening? Well, we are basically facing a perfect macro storm right now. Geopolitically, a surprise Iranian ballistic missile attack has totally shattered the recent truce, and that sent Brent crude spiking right back above $85 a barrel. But here's the really alarming part. The U.S. Strategic Petroleum Reserve is practically running on empty. The absolute floor is 300 million barrels. We're currently sitting at 308 million, and we're drawing it down at a rate of 5 million barrels a week. We are literally weeks away from having zero strategic buffer left. You mix that geopolitical anxiety with a 78% probability of a September Fed rate hike, plus total radio silence from the Federal Reserve leaving us completely guessing on interest rates, and yeah, you get today's absolute volatility apex. Moving right along to Section 3, the China shock 2.0. Now, you really have to grasp the massive difference between what happened back in 2001 and what is happening today in 2026. China shock 1.0 was actually a margin tailwind for the U.S. China exported cheap labor and basic goods, machinery, textiles. That kept U.S. inflation in check and gave corporate profit margins a huge boost. But China shock 2.0, this is a completely different ballgame. This is a direct, existential tech threat. Today, they aren't exporting textiles, they are exporting cutting-edge AI models and semiconductor manufacturing. This directly threatens the technological lead that U.S. investors have just assumed is a permanent reality, and it places a giant target right on the back of the heavy AI weighting in the S&P 500. Just look at the intense pressure hitting the Magnificent Seven right now. In software, DeepSeek single-handedly knocked $1 trillion off U.S. equities in January alone, and Moonshot's Kimi K3 is right on the heels of top American models. On the hardware side, CXMT's debut just made it mainland China's most valuable listed company. It's gotten to the point where Apple is actively lobbying the White House to use cheaper Chinese memory chips over U.S. suppliers like Micron. And in manufacturing, Chinese breakthroughs in ultraviolet lithography are directly bypassing Western export restrictions, posing a huge threat to European giants like ASML. The protective moat around Western AI dominance is evaporating way faster than anyone expected.
Let's look at Section 4, AI expectations versus reality.
Within the tech sector, we are witnessing a brutal reality check that we're calling hardware exhaustion. It is such a paradox. Take SK Hynix. They post a record $42 billion operating profit, with revenue up 257%. Sounds amazing, right? Well, the market's reaction was to plunge the stock almost 10% because they somehow missed these impossibly high analyst expectations. Or look at Corning. They crushed earnings expectations, projected huge sales growth, and the stock still suffered its worst day in 4 months. The market is just demanding constant, flawless upside. And the irony really peaks with Visa. They beat Q3 expectations, yet they are slashing 7% of their tech workforce. Why? Because AI spending has shifted from pure expansion to cost-cutting automation. The narrative has completely shifted from growth at all costs to a strict demand for actual immediate returns. And that perfectly sets up Section 5, the capital cycle shift. Let's think back to the 2008 housing crisis for a second. The trigger back then was home prices simply stopping their rise, which meant overleveraged borrowers couldn't refinance. That sparked a domino effect that collapsed the whole financial cycle. Now, fast forward to the 2026 AI buildout. The trigger today is the market suddenly questioning the return on invested capital. They're finally asking, okay, when do these massive AI models actually make money? Unrealistic expectations are colliding head-on with extreme capital expenditures, and those ramifications are cascading rapidly downward through the entire semiconductor and hardware supply chain. It's a classic cycle bust. It's just playing out in a brand new sector. To really anchor this, let's look at a brilliant insight from Robert Almeida over at MFS. He points out the capital cycle was funding financial engineering. Now it is funding tectonic technology. But what matters is the multiple you're paying for future ROIC. In plain English, you simply cannot pay infinite prices for heavily delayed returns. At a certain point, the math just stops working. So what does this all mean for us? Well, it leaves the broader market in this state of great imbalance. It's a lot like a massive seesaw. On one side, tech and AI are sitting at an unprecedented 40+% weighting in the S&P 500. It is heavily overowned, and it carries some serious valuation risk. On the other side, you have sectors like healthcare just gangling in the air. Its weighting has actually slid from a 16% peak in 2022 to just 9% today. It is incredibly underowned, even though it offers durable growth and tech-like profitability. This whole situation is like a stretched rubber band, just waiting to violently snap back into place, which is exactly why big institutions are favoring biopharma and medtech right now. Which leads us to our final part, Section 6, the smart money playbook. So where is the smart capital hiding? Right in plain sight, honestly, across three main areas. First up, industrials. They are trading at a premium because they represent unstoppable real-world growth. These are the companies physically building the data centers and space infrastructure for a resource-depleted planet. Think targets like Schneider Electric and Honeywell. Second, life sciences tools. These have basically been treated as dumped-out stocks for 5 years, but they provide the absolute mission-critical instruments needed for AI drug discovery. We're talking Danaher and Thermo Fisher. And finally, consumer staples. They have incredibly cheap valuations right now, and they only require basic economic growth to generate really solid above-average stock returns. These are your durable, inflation-resistant compounders. Your strategy for Q3 is actually pretty straightforward. You need to shift out of high cyclicality risks. That means stepping away from AI hardware and memory, which are facing brutal ROI slowdowns and massive 2028 oversupply risks from China. Instead, you want to move your capital into regime shift targets. This means overweighting those durable compounders like healthcare, industrials, and life science tools. The smart money is actively leaving the overhyped hardware space and pouring into these ignored, highly reliable compounders that have just been totally overlooked for the last 3 years. We have covered a lot of ground today. The geopolitical shocks, the existential threat of China's tech rise, the crushing weight of impossible AI expectations, and that massive rotation into durable fundamentals. The capital cycle has definitively shifted gears. So I want to leave you with one absolutely critical question to consider as you evaluate your own financial strategy. With the regime shifting so dramatically right beneath our feet, is your portfolio anchored in the past, or is it positioned for the new reality? Definitely something to think about. Thanks so much for joining me for this explainer, and I will see you next time.